let's just pick up the story that Ala and I were talking about. Another deal falls apart at the moment between EMA and Egypt. The Chinese and the Egyptians have had a spat over pricing. How critical is 2019 for FDI for Egypt? Good morning, Nancy.
Good morning. Well, we still have the FDI's levels maintained at the same rates, which are around $6 to $7 billion next year. That's on the FDI's levels. Our outlook for USD EGP is still the same. This deal does not really affect our view of things.
Okay, but we're going to get the GDP numbers a little bit later on. Well, they're slated for today. Whether we get them today or not is another thing. You have quite a bullish view in terms of growth, and that ties in to your financial calls. So give me your growth outlook, first of all, and how that plays out.
Yeah, we're seeing growth of 6% next year. We're seeing inflation slowly decelerating in the 17% towards next year. The growth continues to be driven by infrastructure projects, mostly. That's like the main driver for our GDP growth.
Listen, Nancy, when I look at the growth trajectory that you have for Egypt, you also then tie that back into further rate cuts going into 2019. What does that mean for the financials that you track in terms of rate cuts? The rate cuts you say would come later in 2019. So what size of rate cuts are we looking at, and how does that tie back to the financials?
Actually, as a research house, we don't see almost any rate cuts. We see a slower pace of monetary easing due to inflationary pressures. We see the fourth round of subsidy cuts coming in next year with a possible indexation of oil subsidies, oil products, I mean. So that's why we have kind of delayed our view of rate cuts until the end of next year, maybe the fourth quarter of 2019, not before that. And that's a slower pace of monetary easing versus our previous expectations due to persisting inflationary pressures.
Okay, I was looking at some of your key calls on this market, and I picked off just a couple of them, just a couple of the stocks. One is pharmaceuticals, one is autos, and these are very much based on the consumer, aren't they? And that is at the heart of some of your biggest calls for next year.
Yeah, our calls mostly are in the healthcare sector. We have a couple of consumer names. Mostly the healthcare sector, we flag stocks like Ibn Sina, IDH. We like GB Auto in the consumer sector as well. Next year we choose to refrain from stocks in banking stocks, real estate stocks. We believe there's a lot of still some area of uncertainty related to these stocks. So that's why our calls mostly stick to defensive stocks.
So you want to be slightly more defensive, and of course the title of your research piece is A Guide to Fruitful Harvest. So stacked to selectivity, and that fruitful harvest, and this is what draws me into the financials, because at the heart of it, you would say is about working capital. You notice a number of other things, Capex financing, and you say that the Capex financing recovery is awaiting significant rate cuts. So are you expecting a significant uptick in terms of lending and pressure, but reciprocally a bit of pressure on the net interest margin? How do you square the two together?
Yeah, exactly. Well, next year, we don't expect Capex resumption or Capex financing to recover, and that's the same trend that we've been seeing the past few years. We believe that despite companies doing much better than 2017, last year, I mean, we believe that for Capex to really resume a significant rate cuts has to be taken first. And that would be at least 3% for corporates to be able to resume their Capex financing activities. So next year, our view for lending will be mostly driven by local currency working capital, which has been the case for 2018 and 2017 as well. And we expect that to continue to be the case for 2019 until rate cuts resume.